Hello, and thank you for joining me. My name is Tom Clendon, and I am the ACCA SBR online lecturer. I help students pass this exam, and I'm here now to talk to you in this podcast about IFRS 9, about financial instruments, and quite specifically about accounting for derivatives. Now, IFRS 9 is probably the single largest accounting standard, the most complex accounting standard, because it deals with financial liabilities, it deals with financial assets. But actually today I just want to focus on derivatives. That's going to be enough for us. And I'm going to start with a definition. I'm going to start with trying to explain to you what a derivative is and its sort of characteristics, because that will then, if you understand that, that will justify how we then end up doing the debits and the credits. So a derivative is a financial instrument that is entered into at little or no cost, whose value is derived from the price of an underlying item, and is designed to be settled at a future date. So there are sort of four parts of that definition. It's a financial instrument, initially no cost, settled at a future date, and its value is deriving from the price of something else. So, strictly speaking, what is a financial instrument? Well, it's a contract. It's a contract that creates a financial asset in one entity and a financial liability or equity instrument in another. So in a very simple way, if I sell you goods on credit now for 30 days, I have created for me a receivable, a financial asset. You owe me money, but in your books, you've got a financial liability. So a financial instrument is a simple definition. It creates an asset for one party and the liability or equity instrument for another. And a derivative will do that. Now, in order to perhaps to understand why it's entered into at little or no cost, how its value is derived, and the fact that it's designed to be settled at a future date, let me make up a fairly simple example, a cartoon example. You and I are going to enter into an agreement today, a contract, a financial instrument. And under the terms of that contract, I'm going to sell you goods in 2 years' time. I'm going to sell you 100 of coal or 100 units of diamonds or 100 euros or whatever it is. I'm going to sell you something in 2 years' time, and we're going to fix the price today. And we're going to shake hands on that. We're going to have a contract. Now, you and I, when we enter into that contract, we haven't exchanged any money. It's been entered into at nil cost. And we fix the price. And maybe I'm going to sell this amount of coal or oil or diamonds or whatever it is. I'm going to fix the price at 100. Now, in a few weeks' time or in a few months' time, the price of what I'm selling you for 100 may, in the market, the spot rate may fall to 95. Now, that would make me very happy, because I'm going to sell it to you for 100, and actually the market price has now fallen to 95. So my contract seems to be valuable to me, seems to have an intrinsic value, some kind of value which may equate to 5, whereas you're gutted because you're committed to now buying something for 100, which everyone else can buy for 95. So I've got an asset and you've got a liability. So sometimes these contracts are called futures or forward contracts. Derivatives can also be swaps. Now, let me reassure you on two things. We're never going to have to design a derivative. Yeah, it doesn't matter whether it's a forward, a future, a swap, whatever it is, it doesn't matter. And we're never going to have to value them, because strictly speaking, the value wouldn't be 5, it will be something slightly different. But we're not involved in that, just like we're not involved when the business buys a car, we're not involved in deciding whether we should buy a Rolls Royce or a tractor. That's someone else's job. So the car is bought, we need to know the cost, we need to know what it's used for, and so on and so forth as an accountant. Now, there's one exception that I want to make clear at this stage. If our so-called derivative has been entered into in the normal course of business, if our so-called derivative, our contract, has been entered into, and you and I know that I will always physically deliver those goods. I'm actually a farmer and I'm producing milk, and you're a supermarket and you actually want that milk, and the intention on both parties and the experience of both parties is the contract will be completed by a physical delivery, then it's an executory contract and it's not a derivative. Derivatives tend to be capable of settlement in net cash. So both of us could effectively walk out of the contract if you pay me 5. Now that would then be a derivative, because derivatives are not normally going to result in a physical, actual execution of the contract. So I just wanted to make that clear. So we now know what a derivative is, in the broad sense, because we're not doing financial management, we're doing the accounting for derivatives. And one of the issues around accounting for derivatives, or accounting for anything, is the measurement basis that we use. Do we measure them at cost, or do we measure them at fair value? Do we have a choice? Well, logically, if we measured them at cost, they would be invisible because they're entered into at no cost. And yet they do take on a value. As the price of the underlying item goes up and down in value in the spot in the market, so our derivative takes on a gain or a loss. So it's essential, it's a requirement that we value derivatives, that we measure derivatives at fair value. It's a mandatory area where fair value is the only way of faithfully representing. Because if we don't use fair value, we're not going to be faithfully representing the assets and liabilities. They will be missing. We won't be showing the substance. It won't be predictive of future cash flows. It won't be relevant. So it just won't be useful. So IFRS 9 requires the use of fair values for derivatives. However we're using derivatives, or whatever they're using them for. Now, how we actually then account for derivatives does depend on the purpose, does depend on the reason why we've entered into the derivative. Time out for a second. You've come across this before. When I buy land and buildings, as an accountant, I want to know why we've bought the land and buildings. Is it our factory? Is it our head office? So it's PPE, ISA 16, or have we bought it for investment purposes? Because if we bought it for investment purposes, for its investment potential, we're going to rent it out, we're not going to occupy it, then that's ISA 40. That's an investment property. And if it's an investment property and we choose to use fair value, no depreciation, gains to P&L. Whereas if the reason we bought the property is to use it, is to live in it, is to trade from it, then the PPE, if we choose to have fair value, gain goes to reserves, gain goes to equity. So the reason behind having the asset determines the accounting treatment. And the same is true of derivatives. There's 2 reasons why you would have a derivative. One reason, the default reason, is that you're gambling, is that you're trading, is that you're speculating in some way, that you've got the derivative because you think you're going to make a profit. Now, in that case, it's really clear cut. If you've got a derivative, you should have it at fair value always. And the default is fair value through P&L. So every year the derivative is revalued to fair value. The gain or loss goes to P&L. That is the default fair value through P&L. Now the exception is when you use the derivative as a hedging instrument, when you use the derivative for hedging. Now let's take a time out here. Hedging is a risk management process. So businesses have risks, business risks. So if you borrow money and it's floating rate interest, you're exposed to the risk that interest rates go up, and therefore you'll have to pay more money out in the future. If you sell in a foreign currency, if you invoice in a foreign currency, you're exposed to the risk that when the customer pays you and you translate that money back into your functional currency, then you're going to have less money because the exchange rate's moved against you. So when we're hedging, the first thing we need to understand is that we're acknowledging that we have a business risk. Now, some companies, they don't care. They're prepared to take the risk because it can work in their favor. Interest rates could come down. When you translate the foreign money coming in, it could end up being more money. And they could say, swings and roundabouts, in the long run, it doesn't really matter. Other businesses are more cautious and want to have a risk management strategy where they hedge, where they cover that risk. And that's where derivatives comes in. Because if you've got an item that you want to hedge, i.e. a risk you want to cover, you can use a derivative to be a hedging instrument. You can use a derivative almost like a insurance policy that will counterbalance any loss that you have on the hedged item. Having said that, if the hedge item actually turns out to be a gain, then your derivative, if it's been designed as an effective hedging instrument, ends up giving you a loss. There's a yin and a yang in hedging. So that's hedging. Now, once you understand that the derivative is being used as a hedge to cover, what you're interested in now as an accountant is matching, giving faithful representation. So if it's a fair value hedge, then the idea is that the hedged item is actually an asset or liability that's in the books and is therefore throwing up a loss, if we're being sort of negative about it, if we're being cautious about it, that actually throws up a loss which is being recognized in the accounts. Therefore, the hedging instrument will throw up a gain because that's the way it's designed, and the two need to be offset against each other. So it's beautiful, it's simple, I like it. If, for example, you have bought some shares, you've got a financial investment, and you're worried that it's going to fall in value, you can do some kind of sexy derivative which will give you a gain if the investment falls in value. And the point is that with fair value hedges, you're matching, you're pairing the two together. Yeah, the loss on the hedged item with the gain on the hedging instrument, and they're paired together. I'm clapping my hands, I'm making that noise. They're paired together, and that's the substance, that's the faithful representation. But there's another type of hedging arrangement, which is a cash flow hedge. And this is where your risk is perhaps not a recognized asset or liability, but is perhaps to do with variable cash flows in the future. Perhaps there's a highly probable forecast transaction. And so you know that in 3 years' time, you're going to have to buy a new asset and import it from overseas, and you're worried about the exchange rate. So you're worried about a future issue. And therefore, you can enter into the derivative today to fix that price. But if you have a derivative as a hedging instrument on a cash flow hedge, the hedged item isn't in the books. The hedge item isn't throwing up a gain or loss today for you to pair it with. So if it's a cash flow hedge, the gain or loss on the derivative needs to be parked, needs to be sidelined in equity, in reserves, and in other comprehensive income. So this year it's put in other comprehensive income. And then it can be recycled. Then it can be reclassified at a later date, brought back to the P&L when the gain or loss on the hedged item itself actually materializes. Because that way you're faithfully representing the hedging arrangement. Because a hedging arrangement is all about offsetting. Now, you may need to listen to that again. That's the joy of podcasts. If we are going to hedge, if we are going to use a derivative as a hedging instrument, you can't do so retrospectively. You've got to enter into that derivative having made an assessment of what your business risk is, and therefore designing your derivative so that it matches that business risk, that hedged item. So there has to be at inception documentation. If you're going to be hedging, if you're going to classify a derivative as a hedging instrument, there has to be documentation at inception that it is a hedging instrument. And it has to be an effective hedge. It has to have that opposite effect, to the risk that you have acknowledged and faced in your business. So there we are, 15 minutes or so on accounting for derivatives. No numbers. I mean, it's possible there could be a few simple numbers in the exam, but it's not really that type of topic. It's not really that type of exam. You're discussing, you're explaining, and I don't see that there's a big need for you to be all over the difference between a swap and an option and a future, because that's too detailed for the accounting. It is a derivative. It must be at fair value. The default is fair value through P&L. But if it's a cash flow hedge, then you can end up having it going through OCI, accordingly. So that's it. If you want, there are plenty of other podcasts that I have done on IFRSs, so please access those as well. If you are thinking of taking the SBR exam and you either want tuition or you want revision or you want a mock, please get in touch with me. My name is Tom Clendon, and I'm here to help. Thank you very much for listening.